Hey, welcome back, options traders, and a happy new year to everyone. And I thought this would be a really good way to kick off the new year because, really, for any year, but especially for 2023, because we are expecting a lot of volatility. And it leads traders to say, well, if we end up with very inflated option prices, maybe I could use this covered call because, after all, I've heard that it's conservative. And many people say it's the only strategy that's allowed in an IRA. And you hear all of these other things about how conservative the strategy is, and they'll say it's because it's a hedged strategy. Well, is that really true? Is a covered call hedged? Let's go find out. And as always, before we do, please be sure to click like and subscribe. Helps so much to promote the channel and is always very much appreciated. So to answer the question, we have to go back to the definitions of hedging versus speculating. So remember that if you are hedging, the idea is to reduce risk at the expense of reducing gains. So you're just giving up some potential profits in exchange for reducing risk. It's just simply a trade-off in risk and reward. Well, speculation is the same idea in reverse. It's also a trade-off. What you're going to do is to increase risk and trying to increase rewards. So you're actually increasing risk or accepting risk in exchange for potentially increased rewards. So that's really the idea that you want to follow if you're trying to figure out if a certain strategy or a certain morph is a hedge or if it's leaning more towards speculating. So now, keeping these definitions in mind, let's go find out if a covered call is actually a hedge or if it's leaning towards speculation. So here's the risk graph for 100 shares of stock, let's say long at 100. We break even right there at 100. We have unlimited upside potential. We also have unlimited potential downside. But the thing that is important here is that these shares are already in your account. This is going to be the dividing line. So if these shares are already in your account, then this is the risk graph that you currently have. And if you sell a call, let's say the 100 call for 5, you're going to shift from the black to the blue. And notice what happened. You have reduced the break-even point from 100 down to 95, and that's because you've collected $5 cash from selling that call, and it provides a little bit of a downside hedge. But also notice that you have reduced the upside. You've sold off all of these potential gains. So you still have all of the downside risk, but notice that the blue line is just shifted higher by 5 points. So what happened here? Once you compare the original risk graph in black to the blue, which is the covered call, you have given up some of the upside in exchange for reducing some of the downside risk. This is a type of hedge. Now, it's not a great hedge because you still, again, have all of this unlimited downside, at least reduced by $5. But typically when we talk about a hedge, it's really trying to eliminate risk below a certain point. But because it does fit with our definitions, we could certainly say that a covered call is a small type of a hedge. And again, it's going back to the definitions, giving up some of the upside in exchange for reducing the downside risk. But the thing that you have to learn from this video, the thing that's so important, is that whether the covered call is a hedge or if it's leaning towards speculation is the assumption of risk. So the quality of the covered call hedge depends on why the shares were purchased. So if the shares are already in the account, then selling the calls reduces the downside risk. This is the example that we just saw. If you already had the shares in your account, you were already exposed to that downside, it's not going to change that by selling the call. What it's going to do is to give you a small downside hedge at the expense of reduced profits. However, and this is where it gets tricky, and this is where traders will make mistakes, and that is if you buy shares just to sell the calls, the downside risk is introduced into your account. You're introducing downside risk that wasn't there before. And now the covered call is no longer a hedged strategy. It shifts from hedging to speculation. And this is why options and strategies can get confusing. Some people will hear that the covered call is a hedged strategy, but we can also show that it could lean right into speculation. It just depends on the assumption of risk. So for example, let's say that you've got $10,000 cash in your account. You've got $100, let's say, times 100 shares, and this is sitting in cash. So your risk graph is a flat line. Remember, these are stock prices down here, so no matter what happens to the value of the stock, the value of your cash doesn't change. But if you decide to enter a covered call, especially because you've heard it so conservative, you shift from the blue to the black. And now notice what happens. You introduce downside risk that was not there before. So you used to be on this flat line, you've now moved to the black, and this is from buying the shares. And once you enter the covered call, you move from the black to the red, which is what we saw earlier. But notice what's happening. You are increasing the potential for gains because you're moving from the blue to the red. You can make more money, obviously not leaving it in cash and just using the covered call to write these calls. And this is the part that everybody sees and they go, oh, I can grab this cash. And it's an out of the money option, so it looks like free cash. But what they fail to remember is that they had to buy the shares to do it. And they have now introduced this risk. So go back to the definitions. What happened in this case? If we started out in cash and we decided to sell a call just because we heard it was conservative and just because we wanted to grab this nice big fat option premium, you have introduced risk, you've increased the risk in exchange for an increased reward. So kind of interesting, we are still exactly on this risk graph in red. It's the same risk graph that we just saw, but in this case, it is now 100% speculation. And in this case, I would say it's more towards selling a naked put, which is synthetically what a covered call is, but it's because of the reason that you chose to do it. If you decided to sell the call just because you liked the big option premium, then always remember it is speculation. And it's because you're trying to capture an increased return and you are increasing the downside risk in exchange. So keep that in mind for 2023 and really for all future videos. I'm going to be talking a lot about that, kind of a topic that's always talked about here, hedging, speculation, and how to use options to create profiles that are better for you. But if you keep these two definitions in mind, it will keep you out of a lot of trouble if you're trying to go out and sell options because of some potentially high volatility that we may see. Some traders will be using them conservatively, and some traders will be using them speculatively, even though both traders might end up with the same strategy. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.